Hi, it's Larry Gaines, Powercycle Trading, and in this video I'm going to go through the markets and show you what's next for the market based on some key correlations that you should be following. Before I get started though, if you've not received my free ebook, please just go to powercycletrading.com, put your name, email address in there, and you'll get 15 of my top options trading strategies. And I have one more ebook that might have an interest to you as well. The other ebook is Trading E-minis. So go to free ebooks on my site and put your name, email address, and you'll get that right away. Now first let's start off with the macro picture. So here's the S&P 500 cash. Here's a monthly time frame, and you can see we've extended this ascending kind of horizontal ascending trend line here. This is actually part of a channel, the top part of a channel. So I can put that in, make it a parallel. So we've had this channel, we've exceeded it and broken to the outside of the channel. Very similar to what we did, or the markets did back in 06, 07. So you can see it extended up and then finally got up here, exceeded 2000, the 2000 highs, and then pulled back. So right now you're in an area of kind of uncharted waters here. So it's going to either pull back here, stop, have a triple top, or it should pull back, consolidate around this 1550 level, and then look for the next catalyst to take the markets higher. So right now we're testing the highs from back in 07, which came in at 1576. So this is a market where you don't want to get too over leveraged to the long side. You need to kind of wait it out unless you're already long, and then keep your longs, trail some stops, or maybe sell some options above to lock in some profits. A lot of different things as far as managing your positions, but as far as initiating a lot of new positions, you should be very stock selective and don't exceed leverage on any new positions until we find out what's going to happen with the market. It's either going to come back, consolidate, hold, or this is going to be some kind of triple top formation. Now the real strong parts of the markets have been the Dow Jones, which is a lot of the big blue chip stocks, high yielding stocks. So this has really had the big move to the upside. It's broken out above its high, and the S&P is kind of coming in second. It's got a lot of the blue chip large cap stocks as well. What's been lagging though has been the NASDAQ, and but right now the S&P 500 and the YM, or S&P futures, and Dow have been really kind of leading the pack to the upside. So you need to keep an eye on the NASDAQ 100, which has been lagging but finally caught up on Friday. And we need to keep an eye on the Dow transports, which have had a huge move up and are broken to all-time highs. So you can see the extension on the transports, just fairly parabolic to the upside. But these type of moves cannot last. Now the other thing too is we were at the end of March on Friday, or Thursday actually, and that's the end of a quarter. So a lot of this is easy for the institutions to push the market higher because nobody's going to get in the way on the last day of a quarter. So they were able to paint the tape higher, and they're trying to window dress their books. So I expect to look for some kind of pullback in this next week, and then test the market from there to see if it holds some of these key spots. Now let's look at some of the other major correlations that could also affect the markets. Now one key correlation to keep track of is the U.S. bond futures, the 30-year Treasury note. So you can see here we've broken out from a trend line to the upside. If bonds move higher, equities cannot sustain themselves to the upside. The correlation is just always locked in that if bonds move higher, that means money's coming out of someplace, going into bonds as a security asset, and that has to come from someplace else. So eventually this correlation, if it keeps pushing higher on bonds, this will definitely have an impact on the sustainability of equities to move higher. Equities should move lower if this correlation persists and bonds keep moving higher. So on Thursday, bonds made a new high and then pulled back into the close because equities kind of took over the market based on the end of the quarter window dressing. Now here's a long-term chart or view of the Treasuries, U.S. Bonds, and under our current system, the power cycle model, we're currently now long bonds on the system. So it went long on an uptrend on the 22nd of March. So it's currently holding long. Got in 2 weeks ago right here. You can see a break of this trend line on the weekly. Now when you look at the Fibonacci retracement from the high back in October to the low here in March, we're currently at the 50% mark, and normally you'll see a 618 retracement if there's good commitment to the market. So we should probably see bonds pushing up a little bit higher into this 146 6/32 area right here, since it broke this trend line. So if this keeps continuing, the bond money is usually smarter money in the bonds than the equities. So if this bond market keeps moving higher, then you should see a pullback on the equity markets. Now the other key correlation that I'll be tracking closely is the US dollar. You can see here's the US dollar index. It's the weekly time frame. Our system is currently up. It's broken through. You can see this major trend line that it broke right here, and it's had a nice acceleration to the upside. Now world commodities are priced in dollars, so as dollars move higher, makes these commodities more expensive, and that reduces the demand. So if you keep having a higher dollar, eventually things like basic materials, those type of commodities, and the stocks that are related to them are going to stall out and pull back because there's going to be less demand because of an increased price based on the cost of the dollar that the amount of dollars that you have to pay to buy that commodity or those commodities. So keep an eye on the dollars. If it keeps moving higher, if bonds keep moving higher, those correlations will upset equities, and it would be very rare situation where equities would just keep moving on the pace that they're moving currently. The other key component of correlation is the euro dollar. So here's the long-term time frame of the euro. Now the euro is, when it's pushing lower, that means money's coming out of the euro and it usually flies into the dollar. So this is still on a really hard downtrend. So if the euro keeps moving lower, that's going to keep pushing the dollar higher, and that's going to affect commodity prices. Now the last correlation to keep track of is the yen. So yen futures, or you can look at dollar yen, but this is the yen futures. You can see this huge move to the downside, and now we've formed a base or a bottom, and we've actually, on our power cycle model, it's currently now popped us into a long trend on the Japanese yen. So this is a short covering. A lot of this can be attributed to short covering, and but the potential, if it breaks through this moving average here, you could get back up here to the top at 110 based on the amount of shorts. So if this accelerates and starts moving faster to the upside on short covering, that's going to have a correlation to affect the U.S. stock equities as well. That'll push put a little resistance to the stock market in general. So keep an eye on this. So the main correlations, again, to summarize: watch the U.S. Treasury bonds. So if those continue higher, bad for equities. Watch the U.S. dollar. If U.S. dollar continues higher, that's going to be bad for a lot of sectors, primarily the basic materials, crude oil, things like that. And keep an eye on the yen. If the yen keeps moving higher, that's going to have an overall effect on equities to a neutral or negative standpoint. So I hope this helps you in your trading, and good luck next week. Now one more thing, we're going to be currently getting close to coming back into earnings seasons, and I'm going to be putting on a two-day webinar boot camp. It'll be 2 nights. It'll be Wednesday the 10th of April and Thursday the 11th, excuse me, and it'll be 2 hours total, and I'm going to go through some really great earnings type of strategies that are delta neutral or neutral and non-directional, and some other really great resources for you to use for earnings. And it's going to be a very extensive, detailed 2-night event. So if you want to learn how to take advantage of the volatility over earnings season, I think it's going to be a great learning experience for you. So good luck, and I'll talk to you very soon.